Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Um, about a few days back, Persistent Systems came out with numbers which beat the street estimates. And frankly, if you look at the mid-cap IT space, for lack of a better word, it's peppered with companies which have managed to do really well. And the question that comes to mind is this the start of a trend of IT outsourcers doing niche products, niche things, and gaining scale, whereby they might be able to do this consistently for a period of time? So one brokerage house said that Persistent is our top mid-cap pick for 2021. Another said that the company is on a song. The argument being laid out here is that despite the sharp run-up, the combination of improved revenue visibility, steady margin expansion, and relatively attractive valuations probably make Persistent a compelling story. Are these possible in a year of supply side pressures, wage hike led margin pressures, and COVID disruptions? Let's ask that to Sandeep Kalra. Uh, he joins us right now on the show. Sandeep, good having you. Thank you so much for taking the time out, and I hope all is safe.
Thanks, Neeraj. All is well here, and thank you for having me on the show. Hope the same with your team and your customers. So, to your point, let me just give you a color on the revenues, etc., for the last quarter, and then we'll delve into your other questions. So, revenue for the last quarter, as you would have seen, came in at $152.8 million. That was a 4.6% quarter-on-quarter, 20.3% year-on-year basis. That's on the dollar terms, and on the rupee terms as well. For the year-on-year basis, for the last quarter, we were at 20.2%. Now, for the full year, we came in at $566 million, roughly about 12.9% over the financial year 20. And in rupee terms, the full year growth was 17.4%. Now, as far as Persistent is concerned, from our perspective, as you rightly said, we are a niche company. We are not a general purpose IT services company. We are focused on outsourced product development, taking the same tenets of product engineering to the enterprise. So what people are coming to call digital engineering. And that's where we specialize in. So that's where our turf is. And we take that in terms of doing custom products or applications, or using niche platforms like Salesforce, using cloud technologies like AWS, Microsoft Azure, Google, GCP, and the likes. So that's the landscape. Happy to answer any questions.
Okay, Sandeep, could you tell us if the Persistent of or since the time you've taken over and the changes that you may have brought, is the Persistent of now radically different from the Persistent, say in the first half of the last decade, if you will? Because I remember a product-focused company, multiple deals with multiple global players like IBM, and a lot of people telling me that Persistent at times feels that it's ahead of its time in India. Would you say that the current Persistent is radically different from what it used to be?
So the current Persistent has built on the foundation of last many years. So Persistent was started about 30 years back. We went public in FY10. We have grown significantly well since then, delivering a CAGR or the cumulative annual growth rate of about 15% from the time we went public. Now our core tenets remain the same. We have pretty strong expertise in doing digital engineering. That is what we are building on. Will we take on full product related relationships like we have done with the likes of IBM and some others, where we do end-to-end engineering, and in some cases we do revenue share as well? Some of that will continue. The core tenet being we are good at product engineering. If we can do it end-to-end for the biggest technology companies in the world and for the biggest unicorns in the world, we can take the same forward with those companies as well as enterprises. So core fundamentals remain the same. We are accelerating our growth. We are building further on our technology expertise in niche areas. And that's where we compete with the biggest in the world, whether it is, US majors, European majors, or companies from an India heritage perspective.
Interesting. I would still ask you, purely from a layman perspective, would you believe that the more predictability to your business on a quarterly basis? I know that you guys as people who are running a business don't look at it on necessarily on a quarter-on-quarter basis, but maybe on a year or a 5-year basis. But I'm just trying to understand this more predictability and a steady state curve of growth that your business is now showing. Is it a factor of you being more service focused, more large deal driven compared to what you may have been relatively, say 5 years before?
Sure. So yes, parts of that is true. So what we are focusing now on is larger multi-year kind of deals, which basically gives us a more predictable revenue profile. So what it means is if we are booking larger deals over multiple years, the base for the future years is becoming more and more. So that gives us a little more ability to grow in a much more predictable manner. And that's what you have seen over the last, many quarters pan out. And that would be the trend going ahead.
Okay, so you displayed growth and very decent growth in FY21 over FY20. On this base, right? And a lot of the larger peers who are talking about a low double-digit growth didn't factually have growth in FY21 over FY20. So when people are comparing IT services, they're looking at growth, but they're saying that, hey, hang on, if you look at compare it to FY20, it isn't as spectacular, to be honest, if that's the base. Now you've grown 13% in FY21 over FY20. Would you reckon, and that's what the street expects you to do, maybe, would you reckon that you could do about 20% dollar revenue growth in FY22 over FY21?
So Neeraj, let me give you a color on the business. We don't give forward-looking guidance, so I'll not state, give you a percentage growth figure. But let's go over a few things. In the last financial year, if you look at it, at Persistent, we grew every quarter. There was not a single quarter in the COVID time that we went down as compared to, many of our peers who had their own business dynamics to deal with. So from that perspective, people should understand that the services we offer are very relevant in COVID times, before COVID times, and I'm pretty sure with COVID times, there is a lot of digital transformation journeys that have started, which will continue for us and many other peers of ours for the many years to come, at least for the next 2 to 3 years to come. So there is definitely a tailwind we are carrying with us, and that should see us grow well. Now, if you look at the last quarter, we grew in dollar terms at 20.3% year on year. So that should, basically give people a kind of a directional view to where, we have built a foundation. And hopefully, the demand environment being what it is today, we should be in the top quartile of growth in the industry, whether it is Indian IT industry or the global IT industry.
No, top quartile, I would understand. Okay, the argument, Sandeep, let me try and tell you. And I appreciate the fact that you may not want to put numbers, but the argument that is being made is that your exit to FY21 was good. In the second half of FY21, and please correct me if I'm wrong, but in the second half of FY21, you won deals which were near about 80% of your FY21 revenues. And therefore, the ask of the deal wins for you to reach a very high growth number, 20 odd percent, is not very high, and therefore you should be able to do it. Is that a fair assumption?
That could be a fair assumption. But reality is, obviously the quarters will tell. And, so from our perspective, look, we are building a business for the longer term. We are in the business of building the company for the next 5, 10, 15 years, right? And from that perspective, I would say if you look at year-on-year growth, we've brought a decent growth in pandemic times. That should give people the confidence. We are focused and we'll give it our best to deliver the best possible growth.
Okay. How is the start, Sandeep? The first quarter, how is the deal win likelihood and what's the start looking like?
So the deal environment remains healthy. In terms of the pipeline is healthy. And, we have said that as long as we are in the 200 million TCV plus minus range, some quarters will be higher, some quarters may be there, some quarters may be lower. We are looking at a healthy growth trend for ourselves as a company. And so we are really seeing the same trajectory. And so it bodes well for the future.
Okay, one quick follow-up actually on deal wins. An argument that one investing team was making at a webinar that we had kept at BloombergQuint was that they were saying that now mid-cap IT, and I'm classifying it as mid-cap IT, excuse me if you don't, but I'm just using that term, that the smaller IT companies, relatively smaller IT companies have grown in scale so much that they have a seat at the 100 million deal table, and therefore they are able to bag $50 million deals, $100 million deals, 50 plus, 100 plus, a lot more recurringly than what they have been in the past. Would you believe that would be the case, and the likelihood of you winning more and more of such larger deals would be only more recurring as time goes by in the next couple of years?
That is a good hypothesis. I would say that's a fair hypothesis. We are being looked upon as disruptors in the industry. So on one side, people talk to the Accentures of this world, to the larger Indian, heritage players and so on. On the other side, we are brought in as the disruptor, where we are able to bring in the expertise that we have in the niche areas that we play, the kind of management attention that we bring to bear, the kind of talent we bring to bear, the kind of solutioning we bring to bear is pretty differentiated. And that's what is giving us the right to be having the seat at the table and hopefully participate in more and more of these. And I would want you to look at it in an analogy to a T20 game. In a T20 game, you will always have ones, twos, and threes that you require, but then you will have some of the fours and sixes that you need to win the game. And so more and more, we are being invited to hit those fours and sixes, and hopefully, that'll be the trajectory going ahead.
Those guys typically win the man of the match awards as well, Sandeep.
Yeah, the jury is out.
The jury is out. Okay, fair call. Your headcount grew nearly 29% in FY21. Is that a sign that you're upping the game in order to be able to execute at a much faster clip in FY22, FY23, and beyond, or rather, actually not beyond in the near term?
Yes, Neeraj, that would be a fair assumption because look, a significant amount of our business, whether it is even dealing with, the larger deals, smaller deals, IP deals, whatever, at the end of the day, it translates into our ability to ramp up. Our product is our services. Services are based on, headcount. So that's a good, forward-looking indicator of things to come.
But in a scenario wherein almost every company, and even the companies which are doing really well on the execution front and have had good run rate, are talking about attrition pressures and wage issues. Of course, I'm very glad you've grown this headcount. What's the kind of pressure you're facing though, and on the availability of resources, on being able to retain those resources? And would you believe that you would need to up the wage game in order to keep the talent pool that you need in order to be able to execute what you want to?
Yeah, so it's a combination of all of the things that you said. So on one side, look, we are in a niche space. Our talent is always going to be in demand. And whether it is a talent that we are seeking from the market or whether it is our existing talent. So that will definitely put a pressure on things like attrition. And we have proactively planned our hiring in a way that we are mitigating both sides, the demand fulfillment and certain amount of attrition uptick. And we were the first ones to come out 2 quarters back when we hired 1,600 people on a base of 10,800 people. We clearly said, look, what we are seeing a few quarters from now is as everyone starts ramping up, there will be pressure, especially on the niche skills. So we are prepared for that. Would it mean that we may have a little higher pressure on salary increases and other things? There may be, but that's the environment for everyone, and we will have to be operationally more efficient to be able to absorb these, along with having the revenue increase, which will get spread over a larger, or the SG&A would get spread over the larger revenue increases that we are seeing. So there are puts and takes. One will have to prudently run the business, whether it is the revenue side of the house or cost side of the house, and that's where the things are.
Again, I'm not trying to get everything out from you, but I'm just trying to understand that at times in high growth phase, typically businesses tend to let go of trying to score up on the margins because the growth is so enticing and you would want to take growth at the cost of that. Are you in that position right now, or do you believe both are happening concurrently, or no, really you can do growth, but at the same time you can up the margin game because of the better pricing or what have you?
So Neeraj, over the last year, if you look at it, we have increased the revenue and profits both, and profits have increased significantly in disproportion to the revenue increase. So we have somewhere created a small bit of cushion. And to answer your question straight, if it's a trade-off between growth and profitability, we will take growth first, and profitability would be tad bit lower a priority, because if you have growth, you can always optimize other levers to get to profitability. So that is our first thing. We have worked very hard to get ourselves in absolutely the growth that is among the top in the industry, and that would be our first priority.
Do you need to make those decisions right now, or currently that's not really the?
Those are ongoing decisions. Those are puts and takes in the businesses.
Okay.
Those are, as you go along, you balance these out.
Okay, fair call. One belief is that you will benefit from higher margins in the alliance portfolio and some other portfolios led by growth recovery, cost cuts. Can that come into question? Any chance of weakness in alliance?
Look, from what we see as of this point in time, we don't see that to be a major concern. In fact, what we are doing now is we are even looking at some of the businesses that are not profitable for us and looking at how do we optimize those, maybe even shed some of those, because if you have growth on your side, you can afford to take some bold decisions. So those are the things that we will do to make sure that, as we go along, it's a portfolio of things. On one side, you're growing very well. On the other side, you have an existing portfolio of businesses. If there are parts of the businesses we need to rationalize, we need to take decisions on. So for example, this is part of our business, which is our resale business, which used to be, software product resales for some of our customers. We are taking that on net accounting now. from this financial year rather than gross. So which will basically mean that we will not account for the full revenue. We'll only take profitability from top line to bottom line and so on. So those kind of decisions today, thankfully with growth behind us, that tailwind gives us the cushion to take bold decisions. And all those are levers we will utilize to make sure we grow well, we have good profitability, and we are taking the right decisions.
Okay. Uh, Never ask a company which is doing very well that how can you do better. But I'm still trying to understand from you because I'm sure you aspire to do even better than what you're doing right now. What's the strategy for up ahead? I hear a lot of your peers, some of your peers, talk about making inorganic moves purely to get stronger in a particular geography, if not a particular vertical, so to say. How are you traversing this landscape on both of those counts?
Right. So you are fair in asking this question. So let me put it this way. We believe we are in a early stage of a multi-year journey of building the company towards our next phase. So I don't think that even today I will claim to claim by any means that we are the best run company. I think there are many places where we could do better. So that is the first point. So to your point of when a company is doing well, so I definitely think as a team we definitely have identified areas where we want to do better, and that'll be a multi-year journey. Whether it is the way we mine our customers and grow bigger and become more significant to our existing customers, whether it is about acquiring the new logos that we aspire to acquire, and so on in a methodical manner. Whether it is about using 268 million of cash that we have for a $566 million company with zero debt, that is net of debt, that is the cash that we have available as our arsenal for doing M&A. And our M&A will be on three pivots. It will be either on making ourselves more sharper in an industry vertical, in some segment of the vertical, or it would be making one of our service lines, whether it is cloud, data, analytics, or some parts of digital engineering, even more sharper. Or third would be our expansion into geographies like Europe and so on. So those are the kind of tenets we are looking at. We have publicly stated we want to be a billion-dollar company over the next 3+ years. And so we are headed there. And all of these things, whether it is our organic growth, whether it is our inorganic growth, whether it is our qualitative things in terms of various other initiatives we want to do, all of those will come together towards that. And so there's lots to be done. That's where we are.
Okay. Just wondering though, with the size and the capabilities that you already have within your portfolio, inorganic moves as they happen would be a string of pearls kind of a strategy, or would you believe that there is scope for a very large, larger than an average sized inorganic move possibilities as well?
These will be string of pearls. So the reason being very simple. We are looking to acquire capabilities, not revenue. Revenue we can do in our customer base. If we look at what do we want accretion of things that make us even more smarter, and people who can come in, join hands with us, the kind of talent that can help us expand even faster, and some geography additions. So it'll be string of pearls, mostly in the range of $10 to $50 million, in that range, and that is where we are as of this point in time.
Okay. The last decade, Sandeep, multiple times, multiple people have written off Indian IT services, and they've weathered it and come out flying with flying colors. Currently, for the first time in a number of years, I see almost everybody unequivocally say that Indian IT and IT services, offshoring, digital, what have you, is going to prosper. That scares me. My question to you would be, in this rosy blue sky scenario, what are the possible challenges that you foresee for you and for the space at large?
So number one, I would tend to believe what COVID has shown the world is the resilience of the Indian IT services, and overall, the companies from India otherwise as well. Now, what it has also done is shown the people, whether you are in the US, whether you are in Europe, or whether you are in India, or you have teams across borders, you can work effectively with each other. Gone are the days when people, used to say, hey, for this kind of work, you definitely need to be in my office, or your people need to be in your office, and these kind of, security parameters are required, and so on. So while security and other things are important, we have shown that we can implement it in a remotely distributed environment. Today, the entire Indian IT industry, or for that matter, the entire global IT industry, whether you are yourself a product company or you're outsourcing to someone else, everyone has tasted the environment where everyone can work remote. So that works very well for the future for Indian IT services, or for that matter, anyone in IT globally. You can work from anywhere and be productive. So that has evened out any more barriers that may have been still there in people's minds. So that ways, I don't think we should be scared about the prospects for IT services companies. I think there are reasonable IT services prospects. Now, what we need to do at the same time is not be complacent. We have to be at every point in time upping the ante in terms of our capabilities. The people who invest in capabilities, the people who can show that, irrespective of where they come from, what culture, what religion, whatever else, but they are able to deliver at pace the best quality products and services, they will thrive. And that's where, companies like us have to make sure we are at the cutting edge of technology. As long as we do that, market is good.
Great. Now, what I was just trying to say was when everybody says that X is the way, then typically at times X doesn't turn out to be the way. That's why. My final question, Sandeep, and this is many years back, of course, so I don't know what the current scenario is. I'm still asking you. That many years back, Anand used to tell me that a very small fraction of the company's revenue or profits, Persistent invests into promising startups, into promising technologies, and who knows, at some point of time they might actually mushroom into becoming something bigger. Do you guys still do that? I mean, it's a great thing, but I'm just wondering, do you guys still do that?
Yeah.
And what is the most promising thing that you would have seen in the last 12 months?
So look, we have been doing that on a consistent basis, and we have done that in two forms. One, we have invested in some startups, and they have given us good view into technologies. Some of them succeeded, some of them didn't, but overall we have done them. So, and because of those companies, we have also have some customer wins along with them, and so on and so forth. So that's one aspect of it. Second is we have invested in a 100 people CTO organization, and the CTO organization does invest in different things, whether it is things like blockchain a few years back when it was not necessarily the biggest thing. And that helped us win deals on blockchain even before people would actually, talk about it. And today, even things like quantum computing, things like those where we have zero revenue and we have zero hope of revenue in the next 2 years, 3 years, we still are investing in that so that when it becomes a reality, we are ahead of the curve. So things like those, whether it is in technology or even in some of the areas in our industry verticals, we do invest in. And there are initiatives, for example, in India on the healthcare side, where we have worked pro bono. But that gives us a good insight into various things, whether it is things like diabetes or human genome, atlas, and so on. So there is many things that we do which are not for here and now, which are forward looking R&D kind of things, which help us being on the cutting edge. So that will continue, and that's been a differentiator for us.
All right, Sandeep, it was great talking to you. Thank you so much for joining in today, and wish you and everybody at Persistent a great time for FY22 and the years ahead.
Thank you. It was good talking to you as well. Stay safe.
Thank you. And viewers, thanks for tuning into this leg of the Talking Point.